Hi there, this is Catherine Tindall. This is the Q&A session from our CPA Academy webinar back on August 30th. So these were questions that I selected of interest to go through for everyone. So let's get started here. Is it correct that the owner and any blood relative cannot qualify even if they are a W-2 employee of the company? So if the owner is a more than 50% owner of the company, their wages and any related parties, if you review that slide in the handouts of who's considered a related party, would not be qualifying wages, even though they're W-2s. Does the related parties owners include or exclude shareholders of corporations, i.e. president and secretary on payroll that are spouses? So this comes back to the same question. When you flow down the ownership of the organization, if it's a more than 50% ownership by an individual, and then you have related parties that are within the ownership structure. So for instance, you have spouses, those ownership percentages will attribute to each other. So say they're 50-50. And even though it's a C corporation or a corporation, because they have the beneficial ownership and because they're related, you would need to attribute that for the 50% test. And then anybody that is over that 50%, them, and then any related parties that are non-owners that work in the business, so say children or parents or things like that, would not qualify. Are there any times when the amount actually received by check is less than what was filed for? If so, are there opportunities for appeal? So very often what we encounter in practice is that if the taxpayer has any kind of tax balance due from any other return, the IRS will automatically apply an ERC credit refund towards that tax liability balance. So a lot of the times clients aren't aware of this, and then they realize that they have a tax balance due for the first time when that mechanism happens. Basically, the process for getting that corrected is just going to depend on why the IRS made that adjustment. And you always have an opportunity to reach out to them to get that corrected if something that they've done is incorrect, or if something that the client did was incorrect and it needs to be adjusted. Either there's an issue with the amended payroll tax return, there's an issue with the way that the IRS processed it, because they are hand processing all of these. It's common to have keystroke errors with them. And then the last piece, the question of appeal, you can also reach out to the taxpayer advocate service, which you can Google that. They're an outside agency from the IRS. So if you're having any difficulties dealing with the IRS, you can deal with the taxpayer advocate, and very often they can help you if you're running into issues, but it'll just depend. Typically, the reason why it would be less is because there's some kind of error or there's some kind of problem within the account. It's not that they've, redone a calculation. Typically, it's not that they'll redo your calculations or something like that. Is there any way to check the status of a 941X online? You can sign up for the transcript delivery service if you're a tax professional. We use a software called Pitbull. There are a number of different softwares that do automatic transcript with the IRS. That's basically the only way that you can do it on the Tax Pro side. Other than that, you can call in to the Tax Pro hotline or the employment tax hotline to get updates. But basically, once a 941X is in the queue, they're not really going to be able to give you too many updates. And they do issue notices when there's issues, but it's very hit or miss with that. In the case where the employees earn less than $10,000 per quarter, don't we use the actual wages paid? Yes, $10,000 is the cap. So for 2020 the cap for the whole year is $10,000. For 2021, each quarter, the cap is $10,000 per employee. If you exceed that in wages that would be considered eligible, that's the cap. So you can't get any more than that as the eligible base. And then the credit is a percentage of that 10,000. So for 2020, it's 50%. For 2021, it's 70% per quarter, so 7,000. But you're always going to use actual wages paid, and that's why when you hear the 26,000 bantered about, it's very misleading, because a lot of times employees aren't compensated high enough that they're going to hit these caps. And also when you have things like PPP or related parties or other issues that are going to reduce the amount of eligible wage base that you can use for the calculation, very often it can pull them under the cap as well. If a 501c3 qualifies and receives a credit, would an amended return be required since the 990 is an information return? So if part of the wages that are used towards the credit are related at all to unrelated business taxable income where they're paying income tax on it, then yes, that definitely would need to. And then for a regular 990, I would just recommend you consult with the tax pro related to the account, because there's more nuances there, and it's not my practice expertise area. 990s for nonprofits, but my hunch, so this is just a offhand hunch, is that you could record it as a prior period adjustment because it's an information return, and those wages are not they're not deductions the same way that they are in an income tax return where they're deductions, and the 580C rule is specifically for reducing deductions. So, but I would still just talk to a tax professional because that's not my practice area. Is there a requirement for a minimum number of employees? The answer is no. It's more of a practicality thing. So, you only need to have, if you had somebody working 1 hour for you within an eligible window, those wages could potentially qualify. There's no minimum there. It's just when you consider the amended payroll returns requirements and then the amended income tax return requirements, it's a cost benefit analysis of, is it worth pursuing based on how much credit it actually is. But no, there is no minimum. How much should a client expect to pay for the ERC and amended 941s, and when would they pay? So my only real guidance to you here is, each client situation is different, so I wouldn't expect a flat answer to this. What it's going to come down to is basically the scope of the work that they need. Are they going to need a legal memorandum? Are they going to be qualifying under non-revenue factors? And you're going to need a lot of substantiating paperwork and documentation there. What's the scope of the job? How clean is the payroll data? Is there a lot of hand manipulation that needs to happen? So those are all things I would consider of, what would make an ERC claim more or less expensive from a practitioner. And then the timing on when they pay, it just comes down to the terms of what the practitioner determines is appropriate and what the client determines is appropriate. But the one piece I would say here is the client should not expect to pay a contingent fee. So we have a requirement as tax professionals under Circular 230 that we cannot bill contingent fees for this kind of service. And so if your client is talking to somebody that's charging a flat percentage or charging a contingency fee, that would be inappropriate. But I would just expect it to be, there's a lot of legwork that goes into these credits, and there's a lot of reliance on the tax pro's ability and the development of their own tools to do these, because we don't have tax software for this. And it's very messy dealing with the IRS with the processing. So, all of that plays into what's an appropriate fee, and it's just really going to be dependent on that client situation and scope of work. A few of our clients are getting IRS notices charging interest after we filed the amended 1040s. Is this something we can get dismissed? So something to keep in mind is that when your client has filed for this, they would have been paid interest on the claim itself. And so even though they're having to pay interest on that amended 1040, usually those interests, it's a wash on the interest side of it. On the penalties side of it, that's something where we would pursue trying to get the penalty abated if possible, just because it's due to processing lag times. And really it's not that it was not unintentional on the client's part why there was an underpayment of tax. It's really just an administrative thing. So I would try to get that a penalty abated, but on the interest side, it's just a statutory thing. There's really not a way to get that abated. And also you've been kind of compensated on the other side with the interest that was paid on the claim itself. So it's usually a moot point. What about a small cleaning business with cash only employees with a 50% loss in business accounts? So here's a big thing that I've seen a lot. If you have a business or a client who has people who are employees in fact, but they weren't being paid on W-2s and they weren't filing 941s, this is not going to work for you. Now, Should you go back and correct all of that and get those people on retroactive W-2s, file the retroactive 941s? That's a big other question, and it just, comes down to your facts and circumstances there and what the situation was. But that being said, if the client was not paying people on W-2s and was not filing those 941s, there's no mechanism to be able to get the claim, because that's exactly what the IRS is looking for. And the status, people need to have been treated in employee status in order for you to be able to, it's in the name, the employee retention credit. So if they're not on W-2s, you're definitely not going to be able to go back and get it. But if you correct it, would you then be able to, you would have to go through that correction process first in order to do those. The ERC is based on the wages paid and not the employer tax paid. The ERC question mark. The ERC credit amount lowers the wages listed on the 941, which lowers the employer tax only, is the question. So basically, the wage base is what we use for doing the calculation, and then the credit itself is first credited against payroll taxes, and then the additional amount is credited as a refundable portion. It's a little confusing how it's worded on the 941, because people will ask me a lot of the times, well, it says that this portion's non-refundable related to the payroll taxes, and then this portion's refundable, so I'm only going to get the refundable part. You get the whole thing, because, ideally your client has already, or your organization has already paid those payroll taxes. So those are already paid in. And so it would just be, the credit would be for the refund would be for the total credit, as long as your organization is up to date on their deposits for the payroll taxes. So that's how it works. And it's a credit against that payroll tax. And then you get it in excess, you get the credit in excess of what you paid in payroll taxes, is the mechanism of it. Can you report the ERC as income when received instead of amending returns? So the legal requirement under 280C is that you need to match, whether or not the taxpayer is cash or accrual basis, you need to match the timing of the deductions with the timing of the credit. So if you're getting the credits in 20 and 21, the wage deduction that's related within that same year that was produced, those same base wages were producing that credit, you do need to match it. Now, I've heard a number of other tax professionals and tax attorneys who I respect question the practicality of this. And so that's something where the legal requirement is what it is. But when you consider the practicality, that's something, it comes down to the tax professional and the client's discretion. But I don't want to say too much more about that, because in my professional judgment, I think it's a messy requirement of the program, but I treat it as a requirement. Very often, it's actually a beneficial treatment for taxpayers, because most people are operating in pass-through entities, where 2020 and 2021 were low performance years for most people during the pandemic. Especially if you're qualifying for the credit, it's very likely it was a low performance year for you. And so those are actually lower bracket rates typically. And so to lose a deduction in a lower bracket rate, and then when the funds come in, say we're now in 2023, where maybe they've bounced back and that money is not a taxable impact in 2023, it's usually, when you triangulate the rates, it's actually a beneficial treatment for the taxpayer, other than the annoyance of having to amend the return. But the legal requirement is you do need to amend the return. But in the practicality of how things shake out, I've heard practitioners with varying opinions on this, but that is the legal requirement. Does your company provide reviews and second opinions on ERC claims? If so, what is the cost? The answer is yes, we do. We do eligibility analysis. We do reviews on claims, especially if there's a concern about a problem with a claim that was filed. And then the cost is just depending on the scope of the work, what the situation is, what the client needs. Typically, we charge flat rates once we have all the information to be able to scope out the amount of work there. Are windows defined as quarters? For the revenue testing, yes. For the non-revenue testing, no. So like I said, when you're qualifying under the government shutdown or government orders piece, those orders, the eligibility windows or the duration of the order that was impacting, that's meeting all the requirements. And so usually that's not a clean quarter, but it is the window. And so they're not necessarily the same thing, because typically you'll have, for instance, if you look at 2020, very commonly it'll be, March 17th was when all the, say you got a restaurant, all the restaurants were shut down March 17th, and then they weren't allowed to open again until April 3rd. And say, after that, there weren't any qualifying restrictions. So for that client, assuming that that's a qualifying order with all the rest of the characteristics we discussed in the presentation, from March 17th to April 3rd is their window of eligibility. And so only wages paid within that window would work, even though it's nestled within quarters. So that's kind of how you have to look at it. For the revenues, because it's the testing is on and off, it's the same. So you're either going to qualify for a full quarter or not when they're qualifying under revenue declines. But when it's government orders, it comes down to the specific dates of enforcement on those government orders that will give you a window. And very often they can be between 2 quarters, within 1 quarter, but it comes down to the specific dates. What is the wait time again from when the 941X is filed to the receipt of the refund? Does e-filing speed up refund at all? So the unfortunate thing with this is that the IRS did not give us a mechanism to e-file these returns. So there's no way to e-file them. And that's why the wait times are so long, is because we're having to paper file these returns. And then the wait times we've been experiencing historically are between 3 to 4 months. Recently, the IRS said that they had gotten all caught up. That's not been my practice experience. And then also recently, you have to consider, I'm recording this September 1st. And right now, we're in the middle of the extended tax deadline filing period right now for 9/15 and then 10/15. So I assume that they're going to be slowing down on processing some of these 941Xs because they're having to deal with just routine income tax filings. So it's really hard to say. Even if you call in and ask them what the wait times are, you always get different answers. But I would say when you file these, just assume you're not going to see the money for 6 months. And then you'll probably be pleasantly surprised, especially if it's in that smaller claim tier. If you're filing a large claim, expect it to be a very long wait time, because it's just, it's a very unpredictable situation there. What happens if your business was affected because customers had a government order that shut them down, or had supply chain issues and there couldn't or didn't have a need for your business? So if you're just having general demand slump because of the pandemic conditions and maybe things that were going on with your customers, that's why we have the revenue testing. I think the mindset with Congress when they came up with this was that, everybody experienced a certain amount of disruption in the pandemic. And to accommodate that, they used revenues as a metric that was, easily calculated and mostly fair. So if your customers were not buying from you, or, things were just, messed up, it's going to reflect itself in your revenues, was what their mindset. And so, that's the first part. And then the second part with the government orders is really more about, so say it didn't reflect on your revenues somehow, but you really were seriously impacted by governmental interaction with your organization, to give you another pathway, even though it's much harder to get everything to line up for it. So if it's just a general demand slump that's going on, or general supply chain issues, or just the general pandemic chaos, that couldn't get employees to come in and work and so couldn't do jobs, that's why they have the revenue parameters of this program. So that's what you have to consider. But, it comes down to facts and circumstances, and, it comes down to what was going on for a particular situation. So I'd recommend you have you have somebody who's seasoned in this do some kind of analysis for you, because unless you're familiar with really all the ins and outs of how the non-revenue testing works, it can be easy to miss things that could potentially qualify, but it is threading a needle. Do you have any knowledge if IRS expects to do 100% audit for the ERC credit claims, or will it be a lower threshold level? Who knows? I would be amazed if they did a 100% audit rate, just given the limitations that they have with budget and personnel and just the sheer volume of what's going on in this program. But I'd say on a practice standpoint, just assume any claim you file is going to be audited and prepare for that before you submit any documentation. So if you want to review the presentation slides, we have in there the substantiating documentation list of what we have from the IRS notices, and then also a sample of it may not be the most current, but a information request related to ERC that you should review, and just make sure that you have all those documents on file. And I would just, the stance that I take as a practitioner, knowing the complications with this program, is I just assume every case will get audited, and we prepare for that so that there's really no concerns, and then also not trying to dig up paperwork after the fact, related, especially if you're going to file for one of these under the non-revenue qualifications with government orders and shutdowns and impacts. You really want to, assume that you're going to be walking into an audit and be well prepared for that, because, like I say in the presentation, you're making a legal argument. You need a lot of support, and you just want to have that all ready to go before you're sending in any 941Xs, just in case there's holes or gaps in your argument. You want to clear all that up before you do any filing, and make sure that you have like a nice, tight, airtight argument and a lot of substantiating documentation before you do anything. So those are all the questions that we selected. Feel welcome if you have additional questions for us. You can submit to the admin team, which is admin@dominiones.com. If you are a tax professional or an organization that would like more specific information and actual tax advice, not just general information, we're available for engagements for this program. And you can reach out to us through our website, which is dominiones.com, to get in touch about having a more formal engagement. We're always happy to do an initial consultation to help guide you on the path of what would be appropriate, considering all the scope of difficulties in this program. So thank you again for attending the webinar, and thank you for watching the Q&A video. I hope you all got a lot of value out of this. And we'll be continuing to offer our continuing education sessions on this program and various niche problems with this program, in addition to other programs in the future through CPA Academy and our own channels. So thank you again, and feel welcome to reach out if you have more specific information needs.